is internal sources of finance? Finance, what is obtained from within the business is known as internal sources of finance. It can be arranged in four ways. About small businesses, the owners will be using their own savings to further support their business. It is readily available, there is no need to pay any kind of interest. But the only problem is it will not be quite enough to support their business activities, because it will be very less. Owner savings will be very less. Suppose they will be in need of a large amount of finance. Then the second method, businesses, about an existing business, they can do one thing, they can keep down the stock level. Instead of going for stock piling, they can keep the stocks at a minimal level. So in that way they can reduce the opportunity cost as well as the cost of storage too. And money what is left with them can be utilized for supporting their business, other activities in the same business. The third one is sale of an existing asset. We cannot say that all the equipments and machineries will be utilized at the maximum level, at the maximum efficiency. No. Some machines will be left over there without even using. So such machineries can be sold and convert into cash, and that amount of money can be utilized for supporting business activities. And the fourth way of finding internal source of finance is retained profit. Using retained profit. What is retained profit? Profit what is left in the business from the previous year's profit. See, the profit what is made by the company is not at all going to be shared among the owners or the shareholders completely. They will keep a part of the profit in the business. That money can be used for further support of financial requirements. Here, they do not have to pay interest because money is readily available in the business. That money only we are using. That amount only we are using. Retained profit is also known as plowing profit or plowing back of profit. Then, businesses may go for external sources of finance too. They may find money from outside the business, maybe from individuals or institutions. The first method is issuing shares. See, the limited companies, they can issue shares to the general public or institutions, financial institutions. Here the major advantage is, even we do not have to pay back the amount. If you go for a loan, if you are taking a loan, the loan amount must be repaid with interest. But about the share capital, by issuing shares, if the company is collecting capital, company does not have to pay back it. See, those who are investing in shares, they will have to know about it. They will have to understand that they will never get back the amount what they are investing in shares. But it can be sold on stock exchange, that is another thing. But company is not at all responsible to give back the money what they have collected from the shareholders. In case of failure of company, sometimes court may interfere in the matter, and sometimes court may ask the promoters or the company directors to pay back. That is another case that we will discuss later. But normally, company does not have to pay back the amount what they are collecting as share capital. So there is no interest to be paid on the share amount or share capital. There is no interest at all. Even the principal amount is also not given back. Then the second method is going for bank loans. See, if you go for bank loan, you have to give collateral security to the bank. Then only bank will give you loan. Again, then you will have to give a lot of documents like projected profit and loss account and balance sheet and the previous year's balance sheet and cash flow forecast, everything. The bank will be asking for many number of documents that, and if the bank is satisfied with all the documents and the company's activity, then only this bank will be giving loan, and it has to be repaid with interest. Then the third method of finding finance externally is selling debentures. What is debenture? Debentures are long-term loan certificates. Long-term loan certificates. It can be sold in the market and company can collect cash. Sometimes it may be for 25 years or 20 years or 10 years. That is up to the company. Sometimes it may be for 1 year also. The period of time the company will decide how long they are in need of money. And it has to be repaid with interest. Debenture amount what they are collecting from the market will have to be repaid with interest. And the next method of finding finance is factoring of debts. See, there are some factors. Factoring, they will do this factoring. That means they will purchase the debt and will give cash. That means the amount what is owed by the company to someone. If you don't have to pay to them, to the debtors, to the person who had given you to the loan, not the debtors. See, the factoring company will purchase the debt and they will pay to the creditor, and we have to pay by installments to the factor. See, factoring of debt. That is another method of finding finance external. And the last one is grants and subsidies from outside agencies like government. Sometimes government will give some kind of subsidies or grants to promote the industries in certain sectors. That also can be used for supporting their business, and if they are getting some grants or subsidies, that amount no need to pay back such amounts to the government. That will be free. So these are the ways of finding external sources of finance. Thank you all.